Hello and welcome to Connect, the weekly podcast of the California MBA, featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Susan Milazzo, CEO of the California MBA. I'm very happy that you could join us today. Before I welcome today's guest, I'd like to thank our 2024 President's Council sponsors. And these are companies that provide a tremendous amount of financial support to the California MBA, in large part so that we can continue to be that strong voice for the real estate finance industry before the California State Legislature and our regulators. So please join me in thanking our 2024 President's Council sponsors. And those companies are AmeriHome, Arch MI, CMG Financial, Consolidated Analytics, Funding Shield, Guild Mortgage, and Western Alliance Bank. Thank you all so much for your support this year. We really appreciate it. And with that, I'd like to welcome today's guest, my friend and good colleague, Rich Andreano, is a partner at Ballard Spahr. Rich, welcome.
Thank you. Thank you for having me, Susan.
You have been a guest on Connect in the past, so welcome back. I thought I'd get started with a topic that you know a lot about. You've spoken at several of our conferences over the years on the topic of fair lending. What are some of the latest fair lending issues that lenders should be aware of right now?
Well, the one issue, although not new, it continues to be very important, is redlining. Going back all the way to October 2021, when the U.S. Department of Justice, they announced a new initiative, and they were correct about being a new initiative. There's been a steady stream of redlining settlements coming out of that. The latest was just beginning of October, and this was interesting. It was the first ever redlining settlement involving a credit union. They've never been subject to a claim before that went to a consent order. So we now have one, and it was redlining in the Philadelphia area, an area where you often do see redlining claims because of the demographics of that city. So that continues. And there's an interesting element in a case that's been going on for quite some time, the Townstone Financial one. And this is actually a lawsuit. Townstone did not enter into a consent order with the Bureau. And it's a non-bank, and so it's the first ever redlining claim against a non-bank. And as you may recall, initially at the district court dismissed the Bureau's complaint on the grounds that the Equal Credit Opportunity Act only applies to applicants. Redlining involves people who are not yet applicants, so the court said, Bureau, you can't bring a redlining claim under ECOA. Went up to the Seventh Circuit, who this summer, unfortunately, and I think incorrectly reversed, finding the provision in Reg B that says the statute applies to prospective applicants, which does not appear in the statute. The statute only refers to applicants. Said, nonetheless, we're holding that the statute applies to prospective applicants. A redlining claim may be brought. Disagree with that conclusion. I think the district court got it right. The Seventh Circuit got it wrong. But there's an interesting element which we may now see focused on at the trial level, because with the motion to dismiss, the court never got to any substantive claims, and now we may see that happen. In addition to the basic redlining claim, the Bureau seems to be really pushing an issue that it's raised before, but now really drilling down. We knew in the past that when they come in and look at you for fair lending basis, they really expect your employees, particularly your loan officers, to reflect the demographics of the communities you serve. So if you're in an area that has minorities, they expect you to have loan officers who are representative of those minority groups. But apparently in Townstone, they're taking that further, where they're drilling down to the individual employee level in terms of functions. So loan originator, loan processor, underwriter, etc. That it's not just across the company, it's in each position you need to have people reflecting the demographics of your community. Now, where they're getting that in the law, I don't know, but this Bureau doesn't particularly seem to care about the law. The law is what it says it is. So we'll have to see how aggressive it is in that area. But stay tuned. I do think in general, having employees that reflect the demographics of the community you serve is helpful, because the Bureau and other regulators do believe that's important, and it helps demonstrate a commitment to fair lending and that you have employees that reflect the communities you lend to. So that I do think is important. The Bureau, now reaching down to individual positions, that's pretty out there. So we'll have to see where that goes. A related issue is limited English proficiency. This is, it's been an issue for a while, but in the fair lending context, I've seen the Bureau and other regulators intertwine fair lending with limited English proficiency, and clearly that means Hispanic borrowers mostly, but it could extend to borrowers who speak other languages and are not proficient in English. We'll have to see where they're going to go there, and I'll mention that in connection with something else in a little bit. But those are areas of focus, and so I think we need to stay tuned.
So considering kind of, the environment with regulators, what advice would you give to lenders that are looking to strengthen their fair lending policies?
One thing that's very important is monitoring. The regulators, both Bureau, Department of Justice, and I see state regulators, believe you need to monitor to see if there are any gaps, if you're falling short in terms of fair lending, and then they expect you to adjust to that. So it's monitor, audit, in auditing, make changes, train to those changes, and then monitor, audit again. And the key here is when you commit to monitor, and I think you do need to monitor, you have to be ready to address what you or whatever consultant you may have hired finds. One of the things we found in a lot of these redlining consent orders is the Bureau or the Department of Justice will note that, hey, this lender knew that there was an issue. Either they had internally done a study, they hired a consultant that did a study, and the results were they were falling short, or even, believe it or not, their regulator had told them they were falling short, and they didn't do anything. That's the kiss of death. If you know there's a problem in the fair lending area and you don't do anything, that's really going to be a problem, and that really seems to get the regulators just angry. Frankly, I think is the best word. That you knew there was a problem and you didn't do anything about it. Why? That's not a question you want to be forced to answer. That's a tough one. So that's that. And marketing is becoming more and more of a focus. Bureau believes that if you go into an area and market, that you need to market to all the communities. So if it's an area that has African American population, you also need to be in media that caters to African American individuals. If there are Hispanics in the area, similarly, and also that adds the element of marketing in Spanish language. Now, I know, particularly in California, when you market in a different language, that can trigger legal obligations. But this is really being looked at by the Bureau, by the Department of Justice, and we've even seen state regulators that if you're very selective in what you market in, and it really is geared more toward white sections of the community, you've got your foot in the hole if they come in doing a fair lending exam immediately. And the Bureau sort of really showing where it's going here in the latest proposed servicing rule, where and I think a lot of us, we think it's beyond their authority to do this, but they're going to mandate certain communications, not only in Spanish, but in 5 additional languages that are the top 5 besides English and Spanish, that you would have to have communications available and interpretations available in these different languages. We don't see where they have the authority to do that, but it's important the industry pay attention to how aggressive they're being, because limited English proficiency is now really a fair lending issue as well as a customer service issue.
Right. And we'll be talking about the new servicing rules at our legal issues conference coming up in December as well. Thank you. Thank you for that. Earlier this year, the CFPB finalized the non-bank enforcement order registry. What should our industry members who are subject to this registry be doing to prepare?
It's very, very timely because they did come out over the summer. The rule went effective mid-September, But what's really more important are the implementation dates, and we just hit. We're in the first window. What they did is they created 3 tiers of companies that have to register a covered order. A covered order basically is either a court or an agency has entered into an order with you that imposes obligations on your company regarding what they cited as prior noncompliance with various consumer financial protection laws. And they reach back to January 2017. So if you have an order that was dated January 2017 or later, and it's still effective, then that would be the type of order that would have to be registered. Now, I mentioned, kind of 3 different phases. One, the first step was for larger participants. Those are for folks where the Bureau did a specific rulemaking to make them subject to Bureau supervision. Debt collection companies, student loan servicers, and such.
Mm,
Their window opened just recently, October 16th. The deadline to register their orders ends January 14th. That's an important date for our industry because that's when the second tier's window opens, and that's January 14th through April 14th. That's for CFPB supervised entities. Under Dodd-Frank, mortgage lenders, mortgage servicers, and mortgage brokers are CFPB supervised entities. So most of our industry will be in Tier 2, window opening January 14th, deadline April 14th. Anyone else who conducts consumer financial services or products, and for some reason isn't in the first 2, they're in the third, which is April 14th through July 14th. But again, our industry is going to be in that middle tier. And unfortunately, because our industry is subject to supervision, not only do they have to initially register a covered order, annually they have to go in and file an attestation that the information is still accurate or they've updated it. And that has to be signed by a high-level executive. And I'm not sure the industry's been focusing on the need for that, for the high-level executive to do this annual attestation. The only relief we got, and this was from some advocacy on the part of the industry, is that if there is an existing order that's up on the NMLS, and the Bureau was not a party to it, so it was other agencies, but not the Bureau couldn't have been a party to it. Then there's an alternative registration where you could one time go in and add some information, exactly what yet we're waiting for that. We're waiting for some guidance on exactly what that will be. But that will be a lesser requirement. So that was the one thing they gave us. Our argument was that you shouldn't adopt this at all because most of these orders are on public websites or the NMLS, which is public.
right.
Why do it? And even the Conference of State Bank Supervisors was very much opposed, and ARMOR, they were very much opposed to the Bureau doing this. So it's very interesting. You get 2 state regulators, particularly regulates the mortgage industry in part, saying don't do this. But they
Right.
went ahead and did it, unfortunately.
Gosh, yeah. Well, great information and things for our industry to be thinking about. Be prepared for that filing period so you can make sure that you're in compliance, whether you agree or not with the ruling. Looks like we're going to have to participate in that. So thank you for that. I'd seen recently that your firm is merging with Lane Powell. I was interested to know how does that merger strengthen Ballard Spahr?
Yeah, thank you for raising it. We're very excited about it. Ballard Spahr is an old law firm going back to the 1800s, and it started in Philly, but we've been steadily expanding and moving west, and the west is important to us. We have an LA office. Also, we're in Phoenix, Vegas, Denver, and Salt Lake City, but this now gives us the Pacific Northwest in terms of Seattle and Portland, as well as Anchorage, which I will not be visiting in January or February. If I could avoid that at all. Plus, a lot of the Lane Powell attorneys are licensed in California, which is we're very happy about, and we do want to do more in California. But where they have great capabilities, including merger and acquisitions, helping emerging companies, prime client services, which is the new fancy word for like trusts and estates and estate planning. It's now called prime. We have that. That's what we call it too. So it's the same sort of practice. Construction, aviation, obviously, with the Pacific Northwest being big, senior care and housing, which really fits with we have a big housing practice, and something that we also have a big practice in, but this helps us out more on the West Coast, is employment law, including California. That, as you know, in California, that is something any employer has to spend a lot of time on, given California, there's California, and then there's the other 49 states in terms of complexity, in terms of employment law. And California is the most difficult by far. So we're really excited about this. Their firm is actually older than Ballard Spahr. They go into the 1800s as well, and are about 150-year-old firm. So it's very rare that we encounter a firm that's older than us. But in this case, it's true.
Well, that's great. And congratulations. That sounds very exciting. I know the years that you and I have known each other, you've always talked about having the firm more involved out on the West Coast. So it sounds like you've got a great partnership there to make all of that happen.
Indeed.
Excellent. Excellent. Well, Rich, thank you for being so supportive and being a good friend, and being a member of the California MBA through the firm, and of course, a continual sponsor at our upcoming Legal Issues and Regulatory Compliance Conference happening in December in Irvine. I'd love for you to share with our listeners why you choose to volunteer and support the California MBA.
And we're happy to do so both through the support of the conference and being a member. California, without question, is the most important state in our industry. There's just no question about that. Not only the amount of the business generated, which is very significant, but also, as you know, a lot of ideas perk up in the California legislature. And then then they kind of like the weather, they move from west to east. So it's usually the starting point of trying to get our advocacy involved. And that's why we like supporting the CMBA, because the CMBA is great in terms of advocacy, letting the members know that, hey, this got introduced into the legislature, it's on fast track. And as you know, Susan, often the CMBA has been very good at getting the legislature to pump the brakes on some issues. Hey, you're moving too fast. There's issues you haven't thought through here. And then by getting them to think of it in a more reasonable fashion, can get it killed. In other words, they finally realize, no, what you think is a good idea is really a bad idea, or can get it modified so it's more workable. So part of the support is just learning about all these legislative efforts. We are very helpful. All the briefings through the committees and everything and conferences are very helpful. But also then with the industry working as a partner with the CMBA in making concerns known to legislatures so we get more reasonable laws and block ones that are not good. And often what's not good for the industry isn't good for consumers as well. And that's what we often try to point out to them. And great for educating, particularly newer employees who don't know the industry. Go to the conferences, join the committees. Webinars are given, podcasts, a lot of educational efforts. And again, that's why I learn a lot by participating in these efforts, as well as other attorneys in the firm. And that's why I'm happy to participate in these educational efforts by doing periodic updates on the Bureau and other federal efforts, so that people know not only what's going on in California, but at the federal level as well.
Right. Well, thank you, Rich. I appreciate that. And, our advocacy efforts are strengthened by strong members like you. You have always been gracious with your expertise when I ever had a question. And so I thank you for supporting what we do here. And thanks for being a guest on Connect. It's been great to have a chat with you.
Thank you for having me again.
And thanks to all of you for joining us today. To access any of our past episodes, you can follow us on our YouTube channel. We're also available on SoundCloud, Apple Podcast, and Spotify. That's it for this week, and we'll see you next time on Connect.
Here we go.